Imagine waking up one morning to see that the value of your investments has dropped nearly overnight. You check the headlines and your heart sinks. Another financial crisis has struck. Maybe it's a depression, maybe it's runaway inflation, maybe it's a pandemic. The panic, the fear, the uncertainty, it's all too real. Yet throughout history, there has always been a pattern in financial chaos. Every major crash, every market collapse, every economic storm has revealed the same truth. Not all assets behave the same way, and not all investors survive. It's the 2008 financial crisis that erased $10 trillion in wealth, the COVID crash that sent markets tumbling 35% in just 3 weeks, and the 2022 bear market that decimated growth stocks by 70%. 5 completely different crises, each unique in its causes, its duration, and its victims. Yet, despite their differences, 3 types of positions have consistently survived them all. Not 4, not 10, just 3. Financial markets have a rhythm, a cycle of fear and recovery. In every crisis, emotions dominate decisions. People panic and sell at the bottom. They chase trends at the top. They believe they can time the market perfectly, only to find out that they can't. But history has shown that certain positions, held through thick and thin, always preserve wealth. Warren Buffett currently holds nearly 30% of Berkshire Hathaway in cash and treasury bills, ready to deploy when the next market panic arrives. Central banks around the world are stockpiling gold at rates unseen in 70 years. And over the past century, the S&P 500 has returned around 10% annually, surviving every crash and every panic. These 3 positions, cash, gold, and growth assets like the S&P, are simple, time-tested, and available to anyone. Yet most investors ignore them, chasing the next hot stock or speculative trend. The consequence? They lose. But if you understand the pattern, you gain something most investors never have: certainty. Not certainty about which crisis is coming next, but certainty that whatever happens, you can survive it. The reason we focus on 3 specific positions is that financial markets have 3 fundamental states: deflation, inflation, and growth. Each crisis fits into one of these states or transitions between them. During deflation, asset prices fall, cash and liquidity are king. During inflation, currency loses value, and hard assets like gold become essential. During growth periods, businesses expand, earnings rise, and owning productive assets compounds wealth. Each of the 3 positions addresses one of these states: cash for deflationary crises, gold for inflationary crises, and growth assets for recovery and long-term compounding. By holding all 3, you are positioned to survive and prosper regardless of what the market throws at you. The Great Depression remains the ultimate example of a deflationary collapse. Stock prices fell 89% from peak to trough, banks failed by the thousands, and unemployment soared. Investors who held cash and treasury bills during this period had an advantage few others did: liquidity. As prices collapsed, cash gained purchasing power. Real estate sold for half its previous value, entire buildings were auctioned for the price of their lobbies. Investors like Bernard Baruch deployed their cash during 1930 to 1933. Buying high-quality assets at fire sale prices. Treasury bills, meanwhile, paid modest interest rates even as prices fell, delivering real returns exceeding 28% during deflation. Gold also proved invaluable. Initially fixed at $20.67 per ounce, gold's value relative to the dollar skyrocketed in 1934 when FDR revalued it to $35 per ounce. The S&P 500, despite falling 89%, ultimately rewarded patient investors. Those who held through the Depression and reinvested dividends saw wealth compound dramatically over the recovery period, creating generational wealth. Fast forward to the 1970s, an era of inflationary destruction. Cash initially lost purchasing power, but short-term treasury bills adjusted to higher yields, eventually delivering inflation-matched returns. Investors who held a small portion of their portfolio in gold saw their wealth multiply. Stocks struggled during this period, with the S&P essentially flat for 14 years. However, patient investors who reinvested dividends survived the decade and positioned themselves for the historic bull market from 1982 to 2000, where the S&P returned 17% annually. Again, the three positions demonstrated their resilience. Treasury bills preserved capital. Gold multiplied wealth during inflation, and stocks recovered and rewarded patience over time. The 2008 crisis nearly destroyed the global banking system. Lehman Brothers collapsed, AIG required massive bailouts, and credit markets froze. Cash and treasury bills provided unmatched optional liquidity, allowing investors to act when everyone else was paralyzed. Warren Buffett's $40 billion in cash allowed him to make strategic investments in Goldman Sachs, J, and Bank of America, generating tens of billions in profits. Gold initially fell as investors sold for liquidity, but quickly rebounded as central banks unleashed massive quantitative easing. The S&P 500, which had fallen 57%, recovered by March 2013, then entered a decade-long bull market, returning over 400% by 2020. The pattern repeats: cash for deployment, gold for hedging, and stocks for long-term growth. Once again, cash was the ultimate crisis weapon. Investors with liquidity could deploy capital quickly, buying high-quality assets at deep discounts. Gold anticipated the inflationary response from stimulus measures, rising 42% from the lows within months. Cash and T-bills provide optionality and liquidity. They protect against deflation and allow investors to deploy capital during crises. Gold preserves purchasing power during inflation and currency devaluation. Its limited supply and historical credibility make it an unmatched hedge. S&P 500 and growth assets own productive businesses, compound wealth over decades, and recover from every crash due to innovation, productivity, and economic growth. No complex strategies, no exotic instruments. Just three simple, stress-tested positions that survive every crisis and allow wealth to grow over time. Right now, Warren Buffett holds $325 billion in cash, the largest cash position in Berkshire's history, signaling overvaluation in markets. Central banks are buying gold in record amounts, and long-term investors continue to hold S&P 500 exposure despite near all-time highs. The lesson is clear. The next crisis is inevitable, and those prepared with the three positions will survive and thrive. Recommended allocations based on age: under 40, 20% cash, 10% gold, 70% S&P. 40 to 60, 30% cash, 10% gold, 60% S&P. 60, 40% cash, 10% gold, 50% S&P. History teaches patience, discipline, and focus. Investors who survive crashes maintain capital, purchasing power, and optionality. They avoid panic selling, don't chase returns blindly, and focus on long-term compounding. Over decades, the combination of cash, gold, and S&P exposure has turned modest savings into generational wealth, transforming $100,000 into $1.7 million over 30 years. 5 crises, 3 positions, a century of proof. The next crash is coming, it always does. The question is, will you recognize the pattern and position yourself to survive, or will you chase returns, panic, and lose wealth? Cash, gold, and S&P 500 exposure have withstood history's worst crises. They are simple, proven, and effective. If you understand this pattern, subscribe now to ensure you're ready for the next financial storm. Position to survive and thrive while others struggle.